Good morning, everyone who is joining us today from Toronto for another session of IQ Startup Corners, where our objective is to bring valuable information about the Canadian ecosystem to all the businesses, entrepreneurs, and startups which are planning to either launch in Canada or already in Canada and are looking to answers for all the questions they have so that they can effectively launch it. As you know, IQ Canada is a business services consulting firm based out of Canada. Our focus is to bring all the services under one roof for businesses who are launching their business in Canada. Either we do it directly in-house or we have partners in the ecosystem who are happy to come and provide those services to our clients. On that note, today's session is focusing on a very important issue which every business in Canada has to deal with: taxes. You cannot run away with them. You have to be compliant. So the idea was to get the information what everybody wants to know. In that regard, we reached out to our very amazing partner, Mr. David Passner. David is a certified CPA in Canada. He is, in fact, partner with one of Canada's leading accounting firm, Zeifman. David has been a partner since 2016 and in active practice since 2006. For years, he has been working with startups, small businesses, and enterprises. And working with these diverse clients, he has amassed a wealth of knowledge and experience in Canadian taxation in many industries. Some of his focus has always been real estate. One thing what attracts us towards David, and that's why we have referred him so many clients, David is a problem solver. He's skilled at crafting result-oriented solutions that lie within the law while being as creative as possible to maximize benefit for his clients. What I have heard from the people who have worked with David is, regardless of the complexity of the situation, he seeks to help his clients weed through the red tape and reach a finish line in a practical manner. He's actually known by all his clients with his outgoing personality and optimistic outlook. David graduated from York University with BAS Honors Accounting in 2006. He obtained his Canadian Institute of Chartered Accountants CA designation in 2008 and completed his CPA Canada, the in-depth tax course, in 2015. He assists his clients in tax planning, tax minimization strategies, tax compliance, CRA audit, CRA objections and appeal, and most importantly, holding strategies for Canadian taxpayers holding foreign investments. On that note, without any delay, I will get back to David. David, thank you so much for taking time out to be with us here. Thank you so much.
Yeah, my pleasure. That was, wow, that was very kind of you. That was quite the intro. Thank you for that.
And all our attendees who are there with us on this seminar today, thank you so much for joining. And we really hope that you find this 1 hour that you're giving to us today to get all the valuable information you can get with this, one of the most sought after accountant I have known in the last 5 years. Okay, on that note, David, let me start with my first question for you. And we, as you know, IQ deals with a lot of people who are looking to move into Canada. So most of them, they are either new immigrants or they're planning to enter Canada at any point. And the first question which I get to hear all the time from my clients is, at what point do new immigrants to Canada start to pay income tax in Canada? Like some of them say, do I need to file taxes before I land? I was like, no, there is a time. So my first question is, at what time they should be aware and they should start paying their taxes?
Okay, thank you. So that's a great question. So for the most part, the answer that I'm going to give will assume that Canada has a tax treaty with the country that the person is coming from. Canada has tax treaties with most countries, so I think that's a fair assumption to make. The answer is there's no exact time. It's not as though like when the person lands at the airport, that's when they have to start filing taxes. It's not before. The countries look, so Canada and the country that you're coming from look at, when are your ties greater in Canada than in your old country? So, if you move to Canada, just because you land off that plane at the airport doesn't mean you're Canadian. You might be coming to look at the country, you're not sure, you might go back and forth. And even if you decide to stay, you could have a wife and kids back home, they could be in school. So at the end of the day, you look at a certain point in time, and it's not always so clear. You often have to decide what that point in time is going to be, where you feel that your ties, business ties, don't matter. It's more so your family and personal ties are more in Canada. So if, let's say, you land in Canada, you start to rent an apartment, you open up some bank accounts, you start to get insurance, you bring, if you're married, your kids start to come to school here. At the moment when you look at a scale and you can make the argument, and sometimes it's not so clear, sometimes you kind of have to walk into the argument. When are you more in Canada than in your previous country? That's the point in time when you would be considered a Canadian taxpayer. Now, sometimes someone might come to Canada on, let's say, December the 15th, and they intend to become, Canadian. They'll might just say that they became a resident of Canada on the first day of January in the following year. You can tailor the facts really to make it work for you, as long as it makes sense. But that's really, what it is when are your social and personal and family ties greater in Canada than in the other country?
Got it. That was very, very helpful, David. On that note, my second question, which I'm going to ask you right now, is, does it matter if they are not Canadian citizens yet? You did say that, it is not that the moment they land on the airport. But what I've heard in my practice over the period of time, that your tax liability on in Canada is not dependent on your immigration status. Am I right? As you said, it depends on more how much you're connected here. And I've also heard sometimes it's the number of days you have decided, irrespective you're on visitor visa, irrespective you're on work permit. So what we always hear is, does it matter? I still have to pay the taxes if I'm not citizen of Canada. What if I never become a citizen of Canada? Does it change my tax liability? So if you can shed some light upon your status in Canada, which is as per the immigration, versus your status in Canada for the tax purposes, what is the interconnection, how they are related, and does citizenship play any role in that?
Sure, great question. So I can answer it in 4 words. Citizenship does not matter. So, in Canada, and I can't speak, I'm overly familiar with the process, but, some people come here, they can live here for years, 10, 15 years, and they have to pass a test to be a citizen and go through all this paperwork. It does not matter. It happens all the time when, you have somebody that lives in Canada and they get married to somebody that's not from Canada, and they just come here to move. If the day that the spouse moves to Canada, they get married, that person has to start filing taxes here. The citizenship does not matter. And there is a question on the tax return, are you a citizen of Canada? And the government likes to know that, just for like voting and elections and stuff like that. But there are I know people that have been in Canada, friends, not necessarily clients, for 20, 25 years, and they're not, citizens. They just don't want to become a citizen, or they're still tied to their old country. They just don't want to write a test, and that does not matter. It's for Canadian tax, it's based on residency. Just very quickly, people that come here from the States, they get confused, because in the US you pay tax. It's the opposite, citizenship. So you could be born in Canada and be a US citizen when you're born, because your parents were American, and you have to file taxes, in the States, even though you've never actually set foot there. So Americans often get confused on that, because American citizens, it's more based on citizenship. Canada does not care if you're a citizen. It's when you are resident, when you reside in Canada.
So David, I have a follow-up question. When you reside in Canada, what does it mean? I enter Canada today. Am I residing in Canada? Is it a number of days which matter? What do you mean when you reside in Canada?
So it goes back to the first question that you asked, when you're so if you're coming from a country which does not have a tax treaty with Canada, then yeah, the general rule is if you're in Canada more than 183 days a year, then that would be considered. We don't usually look at that rule, just because most people come from, if they're coming from India or from Vietnam, they have tax treaties with Canada. So it really is when that date that your social ties are higher here. So if you land in Canada in June and you decide that you start to rent your apartment and you send your kids to school on September the 5th, that could be necessarily the date. It doesn't matter when you land here.
And just because I heard some countries have ties, some don't, do people start Googling it up? Or most of the time, accountants like you who have international clients, you have the knowledge, you will let them know you're coming from a country where you have ties. Don't just go Googling it up. We can guide you.
Yeah. Like sometimes, don't get me wrong, I don't know every single country that Canada has a treaty with, but I have
Yeah.
a pretty good idea. And most of the treaties are worded the same. Like they're
Yeah.
usually very similar. Sometimes, some tax rates might not be the same, but they're very, very similar. It's very rare that we get someone from a country that does not have a treaty. When people want to move for other reasons to the Bahamas or Barbados or the Caribbean, a lot of those countries might not necessarily have tax treaties, but the ones where I think a lot of your clientele are coming from, most of them should have.
Perfect. Thank you so much, David. That takes me to my next question, David. So we know that there are many sources of income. It could be an employment income, it could be dividends, it could be anything. So the questions which we get asked is, and with time we have known that every kind of income is taxed separately. So my first question in that is, what are the kind of incomes that people will be taxed in Canada?
Okay, so I'll start off by I'll change your question just a little bit, because the classic question, before I talk about what you are taxed on, I get a question all the time. If somebody gets a gift, an inheritance, that's a classic one everybody asks. No, when you receive that money, if your father or mother or brother or whoever gives you a gift, that's not taxable to you. It's not income. You didn't do anything for it. That's a gift. If someone passes away and you receive an inheritance, you will not pay tax, when you get that. Aside from that, pretty much all income in Canada is taxable. So the active types of income, if you're on salary, if you're self-employed, you would have to pay tax on that. If you own a corporation and you receive dividends from that corporation, that's taxable. Interest income is taxable. Royalties are taxable. License income is taxable. Capital gains, for the most part, capital gains are taxable in Canada. The classic one that's often not taxable in Canada is if you own a house in Canada that you live in it and then you sell it. Very often, that principal residence that we qualifies as tax-free. But for the most part, any type of income, capital gains also. Capital gains meaning you sell capital property. The easy thing, people sometimes get confused what that means. For the most part, you invest, you buy shares, let's say in Apple for $1, keep it easy, $1, and then you sell it for $10. You've made profit, a $9 profit. It would be considered taxable. Different types of income have different types of tax rates. It's not black and white. Capital gains typically have a lower tax rate than other types of income, but for the most part, all of that is taxable. And the second part is, which we get a lot, which I think would apply to your clientele as well, is, well, they own property overseas. They might be Canadian residents, but they have property in India or Britain. So yes, that Canadians have to pay tax on their worldwide income. So they have to report everything, even if the income was earned out of Canada. Now, this is where the tax treaty comes into play, because if let's say you own a house, let's say in India, even if you're not a resident of India, you might have to pay tax in India, because it's real property. It's a house sitting on, land in India. And then you're going to say, well, that's not fair. I don't understand. Canada's going to make me pay tax and I have to pay tax to India. That's ridiculous. Why would I have to pay? And that's where these tax treaties are important, because the tax treaty says, yes, Canada might say you have to pay tax, but India gets first dibs on the tax. Meaning, if your tax bill in India is $100 and your tax bill in Canada is $150, you can very often use that $100 as a credit in Canada. So you're only going to have to pay $50. So the tax treaties are important to say that if some places you have to pay tax in both countries, the tax treaty helps us not have to pay tax in both. You have to file in both, and sometimes it's a compliance burden, but often you will not have to pay tax in both countries.
I think so. Your answer here already went into my next question, which I was about to ask. You started with an example of a house there. That my next question is, if you have answered, we don't need to go in. But my next question was this: What happens if somebody's already paying taxes in their home country and they continue to be liable, and now they are now in Canada and they have to pay taxes? I think so. Your answer is very clear. You look into tax treaty.
Yeah, you always got to go to the tax treaty, and sometimes people aren't comfortable with tax treaties. I understand they're not always the easiest thing to read. They're written by lawyers, not by accountants or by any other people. So sometimes you have to read it like 6 times before you understand what they're saying. But the tax treaties are very important. And I will say, as a general comment, is when you do go into these types of transactions, often a taxpayer or a person will do the deal, and then they'll come to their accountant or lawyer after and say, okay, let's file this. And the accountant will say, hey, if you told this to me before you made the sale, we could have structured this differently. You might be, it might not come to a result you want. So it's often better just to have a 15-minute phone call or a consultation, or just to bounce an idea off somebody that is educated in these matters and say, hey, I'm in Canada, I'm selling something, you get it all the time. Well, why would I have to pay tax in Canada if the property is in India? Well, because that's the law. So let's do our best to tailor it that you don't have to pay tax in Canada or as minimizing it by structuring it properly prior to a sale.
Sure. Now, my takeaway from this answer is, being trained as a lawyer, definitely we write to the things in very clarity, so there is no ambiguity. But that clarity becomes sometimes confusing. So if a tax expert like David Pasner needs to read something 6 times in a tax treaty, if you take away one thing from this webinar today, please don't pick up and start reading these tax treaties yourself and totally mess up your entire taxing. Oh, this is what I thought tax treaty said. Go to an accountant. They know how to understand. They understand the tax regulations in this jurisdiction. They have some understanding of how taxes work in other Commonwealth or non-Commonwealth jurisdictions. They will be able to do. Please don't start picking up today all the tax treaties and start figuring out, okay, this is how my taxes are going to look like. Okay.
And on that point also, I'll say one thing is, save your paperwork. Sometimes things come up a year later or 2 later that you have to prove something. You don't necessarily have to keep hard copies and boxes and shoe boxes of papers or folders. You can have them scanned in, saved on the drive, that's fine. But save your paperwork, because sometimes, you need it after to prove something. The CRA, the Canadian Tax Agency, lately, the last few years, when it comes to these foreign taxes, they request, when you want to claim, when you want to say, hey, I want to reduce my Canadian taxes because of taxes I paid in India, let's say, on this transaction, they want a lot of paperwork to prove that these taxes were paid. Not necessarily only a tax return from India, but an assessment from the Indian tax authority saying, hey, I confirm, or something that, yeah, this was paid. Because people can just create returns, fake ones, and then send them into the government, say, hey, so they often want proof that this return was actually filed. So just save your paperwork, because if you lose it and you can't call them or mail them to get new ones, it could be rather punitive.
Absolutely. No, that's very useful. Keep the paper trail. The documents are important. And especially if you're a new immigrant and you can't carry that boxes and boxes of paper, just scan it. Have the electronic version, because nothing talks or nothing can prove your case better than the receipts, the filing notices and all that, because that's what the accountants would need here. Now, I think so. The next is a question, David, which I get asked on a daily basis from the people when they're moving in, and there are various variations of this. Like some people ask, we came to know that we can only bring $10,000 in cash. Where can I stack the other part of the money? How can I transfer my money into Canada? And then the next question is, I have these assets all over the world, and I'm really worried that Canadian government is going to tax everything I have in different parts of the world. Do I need to declare every asset that I have in the world to the Canadian government? What happens to the income coming from this? This is a big web which really stresses out people. So if you can shed some light on that, that'll be great for us.
Okay, so let's start with the assets. So actually bringing the money in, if you have cash, so obviously if you're ever flying into Canada, there's a form you fill out on the plane. Are you carrying more than $10,000 in bills and cash? And so that's just I think a question for the immigration authorities. When it comes to transferring shares and money to Canada, sometimes I think it's often based on the bank that you're or the brokerage that you're transferring the money to. Sometimes they're going to want a letter from the other country, whether the bank or an account. They're just saying that this money is, for lack of a better term, clean money. Taxes have been paid on, and every bank or brokerage has their own rules. That's bringing the money over. When it comes to declaring, so assuming somebody has never been a resident of Canada before, so let's say they're moving to Canada the first time, the first time they file a tax return in Canada, they don't have to declare their overseas assets, their assets out of Canada. But by the second time, you have to. So the Canadian government wants, and there's a form on the tax return that you file. There could be two forms depending on what you own. Pretty much everything that you own out of Canada. Now, if it's a personal use asset, so let's say you own a home, not a rental property, but a home that when you go back to your old country, you live in, you don't have to declare any what we would call personal assets. But anything investments, let's call them investment or capital property assets, shares in foreign companies, foreign bank accounts, foreign loans, foreign debt, foreign real estate, the Canadian government wants to know everything that you own. And the main reason is, number one, is they want to make sure that any income that generated from those assets are recorded in Canada. And number two is, and this is I think more for Canadians, not necessarily people people that are actually from Canada as opposed to people moving to Canada, is they sometimes can, the government doesn't want you to take your assets offshore and not pay tax. The government wants a list of everything that you own, and it's share. You want to know the brokerage. If you own, we have clients with money in Switzerland, or they want to know where is it? What are the shares you own? What is the capital gain? What is the gain in a year per asset? So it's a pretty large form, and if you control a company, a private company outside of Canada, there's other forms you have to fill out, and they want to know everything about that company. What type of income. So there's a lot of compliance around it. These are what I call information filings. They're not like you have to necessarily pay tax on any of this stuff, but the government wants to know everything. And it used to be, they gave you a lot of time to fill it out. It used to be for a year, you could have up to 15 months after the year to fill it out, because sometimes it takes a while for information to come. Now they're at, for some of these, 6 months, some of them 10 months. So there's a lot to fill out, and this could lead into another question that you have is that, well, when you move to Canada, let's say you bought shares of a company. Let's say you bought, again, based on my old example, bought shares of Apple for $1, and you move to Canada, and the day you move to Canada, we say that you become a resident, they're worth 10. And then you sell them a month later for $12. So really you have a gain, because you bought it for $1, you sold it for $12. You really have an $11 gain. But there's a rule that says that for many types of assets, they're only going to tax you on the increase in value from when you move to Canada. So you would only pay tax on the difference between 12 and 10. And these are other reasons why they have these forms, just to see what are the values and cost bases of various assets that you own. They want to know a lot of information. From what I understand, the IRS, the American equivalent, is much worse than Canada. I don't know how that's possible, because Canada is brutal, but for this, but yeah, there's a lot of questions. There's a lot of information, and again, as long as you know what you need, it should be fine. Sometimes you don't have the information, so as long as you make a reasonable guess that, if you don't, and the government would ask, well, where did you get this from? You can say, hey, I bought this asset when I lived somewhere else in 2005. I have no idea. This is the best guess you have, and that's it.
No, that's really helpful. In fact, whatever things you're hearing from David right now, guys, if you have any follow-up questions, please don't forget, put that in the chat. I'm going to take up that with David once we are done with the initial set of questions that we think we've been asked regularly by our clients, which we want to get the answers today. But if you have any additional questions. So David, what I take away I'm getting from your last answer is, if you are a person who has various kind of assets which are outside Canada, and it could be in the form of land, investment, shareholding, which are all capital assets, come in that category. you need to report that to the Canadian government, but timing could be different and the tax implications could be different. So ideal would be the moment you land in Canada, get in touch with an accountant who understand this complexity and the assets over outside, so you know you're in compliance. And because could be in future, they might have to sell some of those assets and bring the money into Canada. So you don't want to do anything wrong that you are unable to bring that money into Canada in the future or taxed very high on that. So better to put all your ducks in the order at the get-go, go and talk to an accountant. On that note, as you said, Canadian government wants to know everything. Am I right? What happens if Canadian government knows that your spouse is not coming, you are the only one coming, and your spouse continues to be overseas? What is the tax implications then? Are you still taxed? What about the income your spouse is making outside? Yeah. What happens to that?
For the most part, yeah, there is a question on the tax return is if you're married, is your spouse, a resident of Canada, and they don't have to be here. They don't necessarily, you can make the argument that you move to Canada, your spouse is staying behind with the kids because they're in school and they don't want to pull them out of school. Obviously, if the government were to question you on it, you would have to prove facts as to how is that possible? Do you never see her or him or, but yeah, I have clients where one spouse is Canadian and one spouse is not. It happens, for instance, all the time when, let's say you have a Canadian and they get married to an American, let's say, and the Canadian goes to America to live with her to start off the marriage. They're not sure where they're going to end up. So we're not going to say that the person from Canada is leaving Canada, because he might decide to stay. He still has bank accounts and his parents and his family's there. The girl in America might not decide to come to Canada. They might take 2 or 3 years to figure themselves out and travel between the two. So they're not necessarily, together. I mean, they're not necessarily have the same tax situation. Now, to have that stay on forever and ever, that might be problematic, but I don't, it's definitely fine if one's a resident and one's not, and the non-resident will not pay tax and the resident will pay tax, that's how that works.
I just hope none of you take this for a reason that just to save tax, don't bring your family. Canada is one country which really believes in family reunification. Most of our programs is when you're coming over here, even as a student, or you're coming over here on work permit, your spouse gets to come with you on a work permit with you to come and work. And even as a permanent resident, you actually get to work here with your family. It's always family application just for the tax purposes. Yes, the implications could be different, but again, important to talk to your immigration representative as well as your tax lawyer, tax consultant, or tax accountant to figure out which is the right strategy for you.
On that point, just nothing to do with income tax per se, but if you move to Canada and your personal income is low, personal income, so you could have significant assets and income in corporations. I'm saying if your personal income is low and you've become a resident of Canada and you have children, once you're here for, I think it's 18 months, the amount of government benefits that you get is extremely high. It's shocking in some cases how high it is. So if your personal income is low, again, doesn't mean you could be very wealthy, but just have low personal income, and you have children, the benefits that the Canadian government gives you are quite high. People, I know some people that even though I shouldn't say this, but they've left Canada, but they still file as Canadian because they want to keep on getting other benefits. Now, obviously, if the government were to find out, they would strip them and demand repayment, and that's within their right. But people do enjoy the benefits that the Canadian government gives low-income parents with children.
That also goes to say this is the country which wants to make sure everybody who is here has actual access to all the basic amenities of life, education, for good education for your kids, health for your kids, and also giving all you these benefits so that everybody can live comfortably. That's the opportunity, and why Canada is such a magnet for people to move and raise their families over here. On that note, whatever David said, guys, just remember one very important part. If the Canadian government comes to know that you have left and you're still getting those benefits, they're going to get it back sooner or later. So just be careful. But that also means is there is a way to do structuring your taxes in a way in Canada, which is much more beneficial, because David, though in Canada, people like to keep their money in the corporations because the corporate taxes are low. And Canadian
Okay,
government has given
that's a
those.
whole other, yeah.
Yeah, but most of the time what happens is what I've seen it from our clients coming from other parts of the world, the corporate taxes are actually higher than the personal taxes. So their personal incomes are much higher than their corporate incomes. But just again, before you're coming, if you have these questions, David and his team has always worked with IQ to offer that initial consults for the client so that they can make informed decisions. I'm going to change the topic a little bit, hiding your assets or bringing your assets, showing your wife.
Don't say hi. Don't
No,
say
I'm not. So
word.
everybody, that's what I'm saying. The question here is what we have always suggested is bring everything, because you will be in the long run, if making Canada as your home, might be disposing some of those assets and bringing the money into Canada. So it's very important from the get-go. You declare every asset that you have so you don't end up in any kind of tax complications going forward. Compliance is the key. You go by the book, you will have no problem in this country. On that note, I just have a very quick question, and I'm gonna, sorry, I just used the wrong terminology before. What are the Canadian income tax rates? Because that takes you a little bit to the question versus corporate versus personal and tiers within the personal income. How does it work?
Okay, so the Canadian has what we call a marginal tax rate system, which a lot of other countries have as well. And the more money you make, the more tax that you pay. Now, it doesn't necessarily like, so for instance, approximately the first $15,000 of personal income is tax-free, in Canada. This is all Canadian dollars. And as you go up the chain, the tax rate could go to 22, 30, 35, approximately 44 to 47. Once you hit about $230,000 Canadian, your tax rate is up just over 53%. Now people get this I get this question a lot. If you're making $230,000, all of your income is not taxed at 53%. It's anything above 230. So, your income still from 0 to 15,000 is taxed like it's zero. It's a marginal tax rate. So that's how it is. And very often people that have corporations, they structure themselves to take advantage to land in certain tax rates, because corporate income has corporate tax and personal income has personal tax. So the top tax rate is 53, but there's also a lot of credits and stuff like that as well. So, just because you have a certain type of income, well, if you have a lot of medical expenses, or you're a charitable individual who gives donations, or you have to pay childcare, that can lower tax as well. But the general rate is about, if you factor in Canadian and the individual provincial, because there's different provinces in Canada, every province has tax rates as well, but the combined federal and provincial tax rate, where I am at least, and every province, the amount might not be the exact same, but where I am in Toronto, it would be 22% to about 53%.
Okay, perfect. So depending, it's a tiered, it's a marginal rate. It's not that if you're making 100,000 and you are at say 27%, the entire 100,000 would be at 27. The first 15 you will not pay taxes. Then it will be the tiered rate for the next 15, next 25.
Yes.
It depends on that. Okay.
Yeah.
And
yes.
what I have, with my limited knowledge, there are different kinds of incomes, which we already talked about, and they are also taxed at different rates. So if you have your own business, you need a tax planning to figure out, are you taking as a salary versus dividend, because dividends are taxed differently. So what is important is, for this system, you need an accountant. You can try to do these things yourself, but then you will not be able to maximize the benefits of various tax credits that you can get, or various tax advantages you can get, because these regulations keep changing all the time. New tax credit keeps coming all the time, and people who keep updated with that are tax accountants, people like David. So please go to them and get the right advice so you can maximize your benefits from their advice.
One other point I should say, I get this a lot too, is in Canada, if you're a couple, the husband and wife file separately. There's no joint filings. People ask that a lot, because I know in America you can file, like a family unit can file as one. That's not the case in Canada. So each spouse has to file themselves.
Okay, perfect. So my second last question is, again, and I'm saying, please, in the meantime, as we are asking question and as David is answering, there must be more questions coming for our participants. Please put those questions in the chat, because David will be happy to answer that post after I finish these last two questions. So That's a very important part, and I touched this before. We talked about everything about personal taxes, and most of our clients with IQ deals with are people who are coming either to buy, launch, or launch their startup in Canada. And so they have their corporations, they have their businesses. We work with startups who want to launch in Canada successfully. We have helped several small businesses which have innovative ideas to launch their business in Canada, and that's what we will continue to do. So question which we get asked is, how are their corporation taxed in Canada? What does the corporate taxes look like, and what they need to do for that purpose?
Okay, so assuming the corporation is taxed by the corporation is owned at least by people that are residents of Canada. So we're assuming that people have already come based on our earlier discussion, they're residents of Canada. So the Canadian tax system for tax rates, there's really two types of income.
Before you go further, I'll just confirm, this is not, you're talking about permanent resident as per immigration, you're talking about resident for tax
Yes,
purposes in
correct.
Canada. Okay,
Correct.
great. Yeah.
So once you're a resident of Canada and you own a Canadian corporation, so it's controlled by a resident or residents of Canada, there's really two spheres of taxes that come in. There's active income and passive income. And very quickly, active income means the company is actively engaged in earning, income. They're making sales. They are selling, products. That's active income for the most part. Active income in Canada, depending on a couple factors, has a corporate tax rate of either around 12% or 26%. Depends on different factors, but for the most part, it's a lot lower than personal taxes. If you have passive income means income under Canadian tax law where you are not, what the government considers not to be actively engaged in business. So interest, if you own real estate and you earn rent, because they consider that passive income. The Canadian passive tax rates, it's going to sound a little bit shocking, but to start off is if you leave all the money in your corporation, the tax rate is approximately 50%, 50, which is very high. But if you take that money out of your corporation and you pay it to your personal self, that tax rate drops to about 19%. There's a lot of planning and numbers that go into that, but at the end of the day, if most of your clients are working for their income, they're actively engaged in their business, it would be about 12 or 26%. As long as the income is left in the corporation, that's all that you pay tax on. And people, if they don't need the money in their personal lives, they leave it there at a low tax rate, they can reinvest it in their business, and that's that. But if obviously some people need the money, they need to live, they need to pay their rent or their mortgage or food on the table, you'll take that money out of your corporation, which you could either take it out as a salary to yourself, which would reduce the corporate income and reduce the corporate tax, or as a dividend, and a dividend is a payout from the equity of the company. That's how you would take the money out. So people make this mistake, and I've seen this from some of your clients also, before they've really gotten started, and it's all a blur. They've incorporated a company.
Yep.
They have a visa, they put all their corporate expenses on their personal visa and their personal bank account. In Canada, a corporation, even though you might own it, is completely separate from what you as an individual are. So it's very important that you separate a separate corporate bank account, a corporate credit card, if you need a loan, a corporate loan, to keep it separate. Now, obviously, if it was done wrong, we can go back and do our best to fix it. Believe me, that's fine. But it's very important that just because you control the corporation 100%, it's not you. It's a different entity, a different taxpayer. There's a whole set of reported requirements around corporations. So keep separate corporate accounts, credit cards, just so everything is easy to figure out when it comes time to file.
So David, what I'm hearing from you is that first of all, corporate entity is considered as a separate entity under corporate law. The concept is this only, and that is the same concept which is followed by the tax regulations. That's a
Yes.
separate entity, even if you own 100% of it. And there could be two streams of income, which could be the active income, which is at a lower rate, and passive income. Just to understand, passive income means, for example, our founders accumulated around 100,000 income in the company, and they invested into another share market, and that 100,000 became 200,000 by the time they took exit. If they leave that 100,000 of income they got from the share market, that would be taxed at 50% in the corp, until unless they take it out in their own hands, and then they will be paying 19% on it. Am I getting it correct?
You are getting it correct. The 50% is for some types of income. For rents and interest, dividends and capital gains is taxed lower. But
Okay.
for the most, on a very simplistic level, you've actually, a lot of people struggle with this concept, and you've nailed it. You've explained it very well. Yeah.
Okay, great. At least I know something as a lawyer.
You
Trained
know
as
what?
a lawyer, we can
I
explain
wouldn't
things.
sell yourself short.
Okay, thank you so much. So on this note, I am gonna go on the Q&A that we have in the chat from our participants, and thank you so much. We still have people when we started they're still there. This means we kept them engaged, and that's a big feat on its own. Thank you so much for staying with us, and we really hope that you have actually gotten the information that you were looking for. Okay, Shivi, I'm not able to see the questions here. Maybe I'm looking at the wrong window, but if you can show me where the questions are.
I can see the questions. I'm on the, just so you know, I'm on the Zoom. There's a Q&A thing on the bottom. There's some questions.
I've been told that there are seven questions, and look into the Q&A. David, can you see the questions there?
I can. I see 6 questions.
So
yes.
Can you go ahead there and start answering by the time I figure out?
Yeah, sure. Okay, so I have a question. I'm not sure specifically what it just says. Is it applicable for work permit holder?
I know. I understand the question. So remember, you were talking about that these things kick in when you're a Canadian, when you're a resident in Canada. So one of the people normally, when they hear the word resident, from their mind is Canadian permanent residency under the immigration. And so what they're trying to say is people in Canada have various status. Some people could be permanent residents, some could be citizen, and some people are on a TRV, like a student permit or a work permit. So what they're trying to ask you is all the tax provisions that we talked about, is it applicable to them when under immigration, they're on a temporary resident visa, like a work permit? And just to make it easy, David, I think so your answer is taxes has nothing to do with your PR, your immigration-based status in Canada. Tax residency depends on the number of days you have lived in Canada, or if there are tax treaties applicable, are you severing the relationship with the country you were in, and now you're establishing relationships in Canada, which can be shown you started renting a house, your kids started going to school in Canada, irrespective of you're on a work permit, you're on a visitor visa, you are on a permanent resident. And David, if I'm wrong, please.
Yeah, no, so you're right, but let me just add something that I think it's an important point that we didn't talk about. So if somebody comes to Canada for a year or 2 or 3 to work, and they know they're coming here to work, right? And they're going to go back to their old home. They're in school, they're in university, they're coming to work. But everything is still at home. I would not consider them a resident, even though they've come here for a few years to work, because they don't plan to stay. Their idea is to go back home. So again, I'm not an expert in what you were just talking about, the different types of visas, but if someone comes here for a couple of years to work and that's it, and they know they're going back, I would not call them a resident of Canada. Notwithstanding that, something we did not really touch on, and I think this hits on it, is that if you're not a resident of Canada, so everything we said, but you come to Canada, you land in these borders and you do some work here. So let's say you come to Canada, someone sends you on a contract, or somebody formed a company in Canada, and you're coming for a year or 6 months to work, and you're in Canada, you have to file a tax return in Canada as a non-resident. So a non-resident generally does not have to file tax returns in Canada ever. The two main times they have to file a return is if they come into Canada to work. So they land at the border and they file and they only have to pay tax on their income that they do here. So if they have assets in other countries, they don't have to worry about that, declaring them nothing, because they only have to pay tax on that. As well as if they purchase real estate in Canada and they sell it, that's the main thing. There's a few more, then they might have to pay tax on that gain. So if you've come to Canada on a work visa just to work, you will likely still have to file a return, but it's a very easy return, and it's only based on that work that you've done in Canada while you're in the borders.
Sure. Muzaffar, I hope you got an answer to your question. And Muzaffar, I will be more than happy to put you in touch with David. Once we get the company incorporated and all that for you, we'll be happy to put you in touch with David so you can do your tax planning right away. The next question I have is from Rachel. Rachel is asking, what if you have already incorporated a company in Canada, but there is still no income? Do I start paying taxes after I get the income, or do I start the moment it was incorporated?
Very good question. Okay, so if you're a corporation, you have to, so an individual files every year in Canada from January to December. It's based on calendar years. Corporations can choose any year end date they want. So they can choose a year end date of August 31st, in which case file for year 31st. So if you have a corporation, you still have to file a return. Once you've incorporated a Canadian company, that company is considered a resident in Canada. But if there's no income, there's no tax to pay. So even if you're late, it really doesn't matter, because you only really have to file and pay tax. You only have to file if you have tax. So very often we get cases where somebody incorporated a company in 2020 and now it's 2023 and now they're only starting to earn income now. So, and they never filed. So we just catch them up. We do what's called nil filings. You still have to do a filing, but there's no tax to pay, and there's no penalties to late file a nil penalty. There's only penalties if there was tax to pay. So yeah, you have to file, but there's no tax to pay if you have no income. And even if you have just expenses, it's worth filing, because in Canada, if you have expenses with no income, you create a loss and that carries forward. So if you've incurred a lot of costs in 2021, let's say, and you start to make income in 2023, those costs can offset your income in 2023.
So Rachel, three things, remember: figure out from your accountant what is your corporate tax year ending. Even if there is no income into the company, you don't have to pay the tax, but you have to file with the CRA. Filing is different. Your filing the tax filing needs to be done. And it, as David said, it could be a nil filing, zero income. So there is no tax payable, but you have done the filing. And one of the very important thing, which David mentioned in the last, if you are incurring expenses, like if you're developing technology or you're doing some marketing, there is no income, those expenses will be corporate losses. And in the future, when you have income, those losses could be used to offset the income. Actually, David, I have a follow-up question. How long you can carry on with your corporate losses? Like if you have losses in 2023 and you make income, suppose you didn't still have losses in 2024, but you're making income in 2025. Can you take both 2023 and 2024 losses?
Yeah, so if it's losses relating to the active, business, you've put money into the business to grow for the future, it carries forward for 20 years.
Oh, wow.
20 years, yeah.
So all of you are here, if you have Canadian corporations, we will ask you to please contact an accountant here. Even if there is no active income, there is no tax payable, but you have to file the taxes. Actually, I have a follow-up question on that. You said there is a corporation, no active income, filing is required. What if all the founders of the company are still not resident of Canada? They opened up a company 2 years ago because their applications are pending. They haven't landed in Canada. They're trying to do things remotely. Do they still have to file the taxes?
Yes, but they would be filing it as a non-Canadian controlled corporation. That's, there's two main types of companies. There's Canadian controlled and non-Canadian controlled. Both of them have to file. Doesn't change. The tax rates change once there's income, if there's ever income, but yes, they have to file.
Okay, great. We have a question for Andy Bowie, and thank you for joining us from Vietnam. I need only to concern about the tax treaty if I need to move money from my own country to Canada, or I have to declare the sources of money.
No,
Um,
you have to, I understand what I think I understand what they're saying. So yeah, it's what the tax treaty is based on. All it says is that, you have to pay tax. Canada says you have to pay tax on all of, your income. But Vietnam, I think that's where you said that the taxpayer is from, or the individual is from. Vietnam, might say, hey, you have a bank account here and you're earning, interest income. We want you to pay tax here on that interest income. So the tax treaty just says who pays, where you pay the tax to. The tax treaty does not have anything to do with bringing money over and where you hold your assets. It's not. The tax treaty just says is that if there's income that could be attributed to two countries based on the tax law of two countries, who
mhm.
get the tax first.
Got it. Got it. The next question we have from our guest HS, with the initials HS. Does low personal income include your personal income include Canadian income as well as your global income?
Yeah, so if you're a Canadian resident, you have to pay tax on your worldwide income in theory. Yeah, that's anything. It could be, you could have all of your income is foreign, it doesn't matter. The first 50, it's approximately 15,000 every year, I mean, the number goes up a bit. So it's about, but yeah, it's on any, as long as you're a resident, the first 15,000 of income, regardless of where it's being earned or from, is considered tax-free.
Okay, the next question is very interesting. I get to hear that question all the time. And David, HS is giving us a little bit more details that he or she is from India. Will you be able to help me in tax planning both in India and Canada, or will you be able to give tax advice only on Canadian tax planning? Typical issue we face is if we have to get a view on both sides, and that's a very realistic problem which
Yes,
many people face.
yes,
So a very interesting question.
absolutely. Okay, so it is very rare for an accountant in a country. Again, I'm sure there are some that knows all the rules of tax on both, countries. It's just very rare. I'm sure they exist and they are amazing superstars, but they are very rare. So the problem people have is, well, if you go to an Indian accountant that just knows the Indian tax law, they'll give you their advice on India. You go to a Canadian and that doesn't know international, and then sometimes it doesn't jive because each country. So what you have to do usually is you find an accountant in both countries who knows the local law as well as how to deal with foreign law as well. Even if you don't necessarily know the foreign law, there's different things that you have to know about Canada when you enter Canada, or when you leave Canada, that a lot of people don't know. So what we have, and I'm sure other accounting firms have this as well, is even though our office is in Toronto and we're strictly a Canadian accounting firm, we have, I wouldn't, they're affiliates, affiliate accounting firms all over, I think in 120 some odd countries. So what we do is if we have somebody, let's say like you, who needs to manage the border, let's call it, between Canada and India, we have some affiliate offices there that we can contact, and work with. And the accountant from India would know how Indian tax law works and how to deal with the border with Canada, and vice versa. So I am not an Indian tax specialist by any stretch, but I have access to accountants there that I could work with who know international, and that's how that would work. So if you want to speak to me, I'd be more than happy to. And if you wanted to proceed, I could introduce you or to our affiliate over there, and that's how that works. But I have seen a few people that are no tax law cold in various countries, but those are usually tax lawyers at elite firms.
Sure. So the long answer, short answer is this, that there could be people who know both jurisdiction. We have many immigrants who have come and were accountants back home and have now got their credentials here. But as you know, taxes keep evolving. They might have learned something 10 years ago, things have evolved. But what David is suggesting is most of the tax accounting firms here, like David's firm, Zeifman, has partners all over the world who are established accounting firms in other countries and jurisdictions. They can tie up, introduce you. They will actually have a follow-up question. So for example, we see you a client, they already are working with a very reliable accounting firm in India. If they say, David, we want to work with you for the Canadian tax planning, can you coordinate everything with our Indian accounting firm? Even if they're not in your network, will you be happy to coordinate, work with them?
Yeah. Egos get checked at the door. I see all the time where accountants and lawyers, they don't want to work with other professionals because they know best or they don't want to deal with anybody. I work with lots of accountants and lawyers that are not part of my network. And I'll even, if I think they're a good fit for a client that I can't handle, I will send them there. I have no problem doing that. So yeah, I like to work with all sorts of people. I could introduce you to somebody in the network that I have, but I have more than many times dealt with people from other networks or not in my network. And it's great because you learn new things and you learn how other people deal with things. And often you can teach them things and they teach you things as well. So yeah, that's absolutely fine.
Vinu, your question is the amount 15,000 CAD per month or per annum? Can you please add a little bit more context to the question, or David, if you get
No,
this?
I think I understand what they're asking. I
Okay,
said
go
that
ahead.
generally speaking, a Canadian resident gets $15,000 a month. The first $15,000 is tax free. If it was $15,000 a month, that would be like $150,000 a year. That would be great. That would be amazing, and then everyone would move to Canada, even though it's cold in the winter. But unfortunately, it's $15,000 a month. So if you make $20,000 a year, you're going to be paying tax on 5.
It's $15,000 a year. Am I right?
Approximately, yes. It's an approximate amount.
Okay, we have another question for HS, and this is his third question. Does one have to file a return even if you come to Canada on work visa and stay less than 180 days?
So if you do any work in Canada, you're an employee or you're self-employed, you have to file a return as a non-resident of Canada. So you won't have to declare any foreign assets or declare any foreign income, but you'll have to file a return just for the work that you did while you were in Canada, whether it was for 7 days or 125 days or 306 days. Anybody that does work here has to file a return.
Sure. Shamir, pleasure to see you here. Thank you for joining us, and I'll take up your question. I'm surprised to have this question, but thank you for sharing your thoughts with us. Shamir is asking a question. What is the tax implication for a permanent resident working for an overseas company from Canada and is getting paid the overseas local currency? How the income is taxed if they get paid as salary, having base salary, housing allowances, and the car allowance?
Okay, so if I understand your case, just make sure you have somebody that's a permanent resident of Canada who is getting paid from a company overseas, and they're paying them. So while they're in Canada, they're an employee of some other company, and they're getting a housing allowance or whatever. So this is something that gets done wrong very often. If an overseas company has employees in Canada, the general rule is they need to register for payroll taxes in Canada and pay you as an employee. So even though they might not have an office here, they have employees working for them in Canada. They need to they have to treat you the same way that a full-fledged Canadian company, where they have to do payroll taxes and you would technically have to file returns. Very often it happens that overseas companies, they don't know the Canadian tax law and they don't do it right. And then they simply just pay you and they don't never file or register with the Canadian government. And then it's just done wrong. So you still have the responsibility to pay tax in Canada, but the whole mechanism that it was supposed to happen is just done wrong because your employer was supposed to register, they never did. So there are what I usually do is we just look at the case facts and we say, hey, you have to file taxes here. Your employer doesn't want to get in the Canadian tax loophole because you're one or two employees here. It's a short period of time. So we deal with that on a case by case basis. So there's no answer per se. We can always talk about it if you want to, but if you're in Canada, you have to file, even if your employer was supposed to send in payroll taxes and register you as an employee, and they never did. That's my answer to you. Hope it makes sense.
I don't think so. We could have finished so perfect, David. It's exactly 10:30.
It was a pleasure doing this. And if any of you have any questions or you want to give me a shout or bounce, an idea off me, you can send me an email and we'll set up a time to talk. I know a lot of you are not in Canada and the time zone is not close to Canada. So very often what I do with these types of people is, we can have a call, let's say 9 o'clock Toronto time, which is I think 9 o'clock, depending on where you are overseas, could be 7 o'clock, 10, 9, 8. So we can always set up, a time to make it work. It would be my pleasure, and thank you for having me today.
Thank you so much, David, for giving us an hour. Thank you so much for sharing your insight and such value-filled information. When I was in law school, everybody was scared from tax law because it is so much numbers. But if it's a feat, we have still the attendees, the number we started with. Nobody dropped off. All thanks to you.
Wow.
You kept people engaged. So
Okay.
that's amazing. Again, if you have any more questions for David, or if you want to get any more consult with us, let us know. We'll put you in touch with David. We'll be happy to share David's contact information with you and take it a notch further. But thank you so much for joining us. As you know, IQ Canada will keep bringing service providers whom we think people need to know if they are serious about coming to Canada, launch their business, launch their startup, launch their enterprise, the professionals that they need. It is our job to put you in touch with the right professionals and help you to be successful in launching your business in Canada. Thank you for joining us for IQ Canada Startup Corners. We'll continue. And thank you so much, David Posner, for giving us an hour. This was very valuable. Thank you so much.
Thank you very much for the opportunity. It was my pleasure. I hope you all have, depending where you are, a good evening, an amazing day, and see you later.
See you. Thank you. Thank you, everyone.
Bye.
Bye.